Welcome to the Deep Dive, the place where we turn massive stacks of research into actionable, streamlined knowledge, customized just for you. Today we're zeroing in on really the climax of the whole property buying journey, the final steps, the closing day itself, that high-stakes transaction.
It absolutely is the finish line. After all those months of looking, negotiating, inspections, suddenly you're facing this mountain of paperwork, critical legal stuff, huge financial decisions. And it's funny, people often feel most overwhelmed right when they're closest to the goal.
Yeah, the pressure ramps up.
Exactly. So our deep dive today is really about cutting through that anxiety. We want to give you the precise knowledge, everything from your rights during that final physical check to some pretty advanced tax strategies so you can walk into that closing totally prepared, totally confident.
Okay, so our mission today: distill the key bits of these final stages. We'll cover the essential physical checks you absolutely need to do. We'll dive deep into the financial and legal checks, the due diligence that confirms you're actually getting the value you think you are. And then crucially, how smart investors think about structuring the purchase for long-term success. We want you feeling completely informed, totally in control, ready to grab those keys. Right, let's kick off with the physical side of things. Probably your most immediate bit of leverage, your protection right before you sign everything. This is that crucial final walkthrough inspection.
Yeah, and the timing here is everything. That's what gives the buyer so much power. This isn't the big inspection from weeks ago with the engineer.
Yeah.
This usually happens right before closing, often like the day of, or maybe just a few hours before you sign the papers. It is the absolute last checkpoint, non-negotiable.
Okay, but what are we actually looking for? What's the point of this last check if the main inspection's done?
It's got one single purpose. Make sure the house is in the exact condition the contract promised. So that means, 1, all the systems are working as expected. 2, any repairs the seller agreed to make after that first inspection, they need to be done, and done right. And 3, the place needs to be empty. Properly vacated, professionally cleaned ideally, no junk left behind, seller stuff gone.
Okay, that tracks. But why is this moment, better for the buyer? Both sides have put in time and money to get here, haven't they?
Oh, totally. But think about the seller's momentum. They've usually packed up everything. They've booked the movers. Often they've already bought their next place. Psychologically, financially, they are expecting those funds today. So if you, the buyer, walk in and find, say, the basement's full of their old furniture, or that dishwasher that was supposed to be fixed is still busted.
Oh, okay. You hold the ultimate trump card.
Yeah,
the money.
Exactly. You're holding the closing funds hostage, essentially.
So maximum buyer leverage. If something's wrong, you can't just, shrug and say, I'll deal with it later. You need options. Let's break down those 3 choices you mentioned.
Right. Option 1, the most, let's say, aggressive move, is you simply refuse to close. Flat out. Not until the house is in the conditions stated in the contract.
Ooh, refuse to close. That sounds pretty nuclear. Doesn't that blow up the whole deal? Couldn't the seller sue or argue it's just a minor thing?
It definitely carries that risk. Yeah, it's why you'd probably only use it for really major breaches. Like you walk in and the furnace isn't working anymore when it was fine before, or that roof repair they swore they did clearly hasn't happened. By refusing to close, you stop the money flow to the seller completely, forces their hand. They either fix it immediately or the whole deal could collapse and they're back to square one, relisting the property. Huge pressure.
Okay, massive pressure. What about choice number 2? Something maybe a bit more pragmatic.
Yeah, option 2 is often the most practical, especially for things like the place isn't quite clean enough or some minor agreed upon repair isn't finished. You insist on holding back some of the seller's money.
Holding back funds. So the closing still happens, but some of the seller's cash gets put aside, like in an escrow account.
Exactly. You complete the sale, but a chunk of their proceeds is held back until the issue is fixed.
How much do you hold back? And who decides?
Usually you'd aim for maybe 1.5, maybe even 2 times the estimated cost to fix whatever's wrong. So if cleaning costs $500, you might hold back $750 or $1,000. This gets negotiated right there, usually at the closing table. The attorneys or the title company will draft a little escrow agreement and specifies the work, the deadline. It ensures the deal closes on time, but uses the seller's own money as collateral to make sure they actually follow through. Much smoother.
Right, that makes a lot of sense. Avoids blowing things up.
Yeah.
Okay, what's the third option? Maybe for something that can't be fixed right away or something that permanently lowers the value.
That's where option 3 comes in. You renegotiate the price based on the defect you found. So let's say you discover the seller didn't mention, I don't know, some minor foundation crack that'll eventually need $5,000 to fix properly down the road. You can ask for a $5,000 credit right there at closing. reducing what you pay. Or just lower the official sales price by that amount. You take the house as is with that issue, but you paid up front for the future cost or the slightly lower value.
Got it. So whether it's leftover junk, an unfinished repair, or a newly discovered minor issue, you've got clear paths. Refuse, hold back funds, or renegotiate price. That walkthrough really is your final powerful leverage point. Okay, let's pivot now. Assuming the physical stuff checks out, the focus snaps right back to the money and the legal side of the deal. This is where you, the buyer, really make sure you're getting a solid financial asset, not just four walls and a roof.
Precisely. And this really starts before closing day, but it's absolutely essential to make sure that closing day represents a sound deal. We're talking rigorous legal and financial due diligence. Hashtag 2.1. Conducting legal due diligence, the loophole. Before you're fully locked in, you absolutely must investigate potential long-term headaches. We're not talking leaky taps now. We mean things like, is the structure fundamentally sound for your plans? Does the electrical system have the capacity you need? Are there weird zoning restrictions? Any environmental ghosts in the closet, like an old oil tank buried out back? Hazardous waste potential? This is the real legal deep dive.
But hang on, these deals move fast, right? Sellers want certainty. How do you do all that digging, environmental checks, legal history, without grinding everything to a halt and maybe losing the property?
The solution lies in how you write your initial offer. You have to include a due diligence period as a contingency for the purchase. This is often called the contract loophole, and it puts immense power in your hands as the buyer.
Okay, walk me through that. How does that contingency language actually work? How long is this period usually, and what are you doing during that time?
Typically, you might negotiate, say, 10 days, maybe 30 days if it's a complex commercial property. During that window, you bring in the specialists, environmental engineers, maybe a specialized title attorney, structural experts. They're looking into things the standard home inspector doesn't cover. Title problems, access rights like easements, making sure the zoning allows what you want to do, maybe even a Phase I environmental assessment if it's warranted.
Okay, so let's say during your 20-day investigation, you find out the city's about to rezone the lot next door for, I don't know, a chemical plant, something that totally tanks the future value. What happens then?
That's the beauty of the loophole. If you're digging, whether it's legal, physical, financial, turns up something you just don't like, something that changes your whole risk assessment, that contingency clause lets you walk away. No questions asked, usually. You get your deposit back. Full stop. It's your ultimate safety net. Ensures you're not forced into a bad deal because you didn't have all the facts up front. Hashtag 2.2. Understanding valuation metrics. Cap rates.
Right, that safety net is crucial. Once that's set up, the focus shifts to pure financial value. And for investment property, you're saying we should pretty much ignore the seller's asking price. It's all about valuation based on the rent it generates.
That's the critical mindset shift. Homeowner thinks comps, emotion. Investor thinks income potential. We use two key things, net operating income, or NOI, and the capitalization rate, usually just called the cap rate, or R.
Okay, let's nail down that formula you mentioned. Value V equals NOI divided by R. Before we can even use it, how do we figure out the NOI? What goes into net operating income?
NOI seems simple, but you got to calculate it right. Start with gross scheduled income. That's all the potential rent if it were 100% occupied. Then subtract what you realistically expect to lose from vacancies or tenants not paying. That gives you effective gross income. Then you subtract all the necessary operating expenses.
Okay, operating expenses, what absolutely has to be in there?
Everything needed to run the place. Property taxes, insurance, utilities the owner pays, property management fees if you use them, setting aside money for future maintenance, common area costs if it's a multi-unit. But here's the crucial bit. You absolutely exclude your loan payments, the debt service. NOI measures the property's cash flow before financing. If you mix in the mortgage payment, you're not calculating true NOI, and your valuation using the cap rate will be totally off.
Right, separating operations from financing.
Yeah.
Vital. Okay, got the NOI. Now, how do we interpret R, the cap rate, in that V NOI-R equation? What's it telling us?
The cap rate is basically the rate of return you'd expect if you bought the place free and clear, all cash. It's a measure of the risk and return for that type of property in that specific market at that specific time. The range is key.
Give us the typical range then. What should we expect to see?
Okay, so on the low end, maybe a 0.06 or 0.07, that's 6 or 7%. That's typical for really desirable Class A properties, stable neighborhoods, low risk, think blue chip assets. On the other end, a high cap rate, maybe 0.12, 0.14, could be even higher. That's for riskier properties, maybe in areas with more economic uncertainty, higher crime, what might call so-so or up-and-coming neighborhoods.
Hold on, that feels backwards. If a place is hot, super desirable, the cap rate goes down, why would a lower risk, better asset have a lower rate of return?
Because of the math. V equals NOIR. The cap rate, R, is what you're dividing by. When loads of investors want a safe, stable asset, they bid the price, V, up. When V goes up, but the NOI stays the same, the resulting rate of return, R, mathematically has to go down. So yeah, counterintuitively, a low cap rate means a relatively high property value because you're dividing the income by a smaller number. And a high cap rate means a relatively low value. Smart buyers use the current market cap rates for that area to quickly sanity check a seller's asking price. Forget the seller's hype. Look at the math. Hashtag tag 2.3, financing terms and risk management.
Okay, beyond just the value, let's talk financing terms. These can get way more complicated for investment properties compared to just buying your own home. Let's clarify two really critical terms that often differ in commercial or investment loans: amortization period and maturity date.
Right. Super important distinction. The amortization period is how long the loan payments are spread out as if you were going to pay it off completely over that time. Could be, say, 20, 25, maybe 30 years on paper. Keeps the payments lower. The maturity date, sometimes called the loan term, is the actual date when the bank wants its money back, all of it. The remaining principal balance becomes due and payable.
And for my regular 30-year home mortgage, those two dates are the same, right?
Yeah.
30 years. But for investment property, they often don't match up. Why do lenders do that?
Lenders, especially commercial ones, don't like being locked into an interest rate for 30 years on an investment property. Too much risk for them. So they might give you a loan with payments calculated like it's a 25-year loan, that's the amortization, but demand the entire remaining balance be paid off in, say, 5 or 10 years. That's a maturity date. Which means, bam, at year 5, you owe this huge balloon payment. You either have to refinance, sell the property, or somehow come up with potentially hundreds of thousands of dollars. Understanding that difference is absolutely critical for planning your cash flow.
Definitely critical. Another big metric lenders use for risk is the loan-to-value ratio, LTV. What's the typical LTV requirement for investment properties, and why is it usually tougher than for a primary home?
Yeah, it's tighter because the lender sees it purely as a business asset, not where you live. If things go south, they assume you're more likely to walk away from an investment than your own home. So while you might get 90% or even 95% LTV on a primary residence for investment property, many lenders want to see an LTV below 80%. 70% LTV is actually quite common, especially from commercial lenders.
Right, so you need to plan on bringing more cash to the table, maybe 30% down payment or equity.
Exactly. You need more skin in the game.
Does having that lower LTV benefit the buyer at all, or just the bank?
Oh, absolutely benefits the buyer. The lower your LTV, meaning the more cash you put in, the less risky you look to the lender. That gives you way more leverage to negotiate better loan terms. Think lower interest rates, maybe fewer fees, possibly more flexible conditions in the loan agreement. Low LTV signals you're serious and financially solid. It translates directly into cheaper borrowing costs and better long-term profit.
Good point.
Yeah.
And speaking of lender protection, we need to touch on something called an assignment of rents.
Yes. If you're borrowing money for a rental property, expect to see this document. It's a legal agreement. Basically, it gives the lender the right to step into your shoes and collect rent directly from your tenants if you stop paying the loan, if you default.
Okay, so if I miss a payment, does the bank just start collecting rent the next day? What actually triggers it?
It's usually triggered by a specific default event outlined in your loan docs, often after a certain grace period has passed. The mechanics are simple. The lender sends a legal notice to your tenants, tells them, stop paying the landlord, pay us instead. It bypasses you entirely. It lets the lender grab the property's income stream quickly to cover the mortgage payments, protecting their investment without immediately having to go through a full, costly foreclosure process. You know, what's really fascinating here is that closing day, it isn't the end, not at all. It's really just the official start of your journey as an owner. And thinking like a real investor means setting up your financial defenses, your tax strategies right from day one. It's about structuring for the long haul. Hashtag 3.1, leveraging debt, positive leverage.
Okay, let's dive into leverage. Most people hear debt and think bad. But savvy investors use borrowing leverage to seriously boost their return on investment. This is positive leverage.
It's pretty much the engine of building wealth in real estate. But, key point, positive leverage only works if the property's own rate of return, its cap rate, essentially is higher than the interest rate you're paying on the borrowed money. When you use other people's money, OPM, effectively, you amplify the returns on the actual cash you put in.
Let's make that concrete. Use the example from the sources. We've got a property throwing off $7,200 a year in cash flow. If someone buys it for $100,000 cash, no loan, what's their return?
Simple math. $7,200 divided by $100,000 cash invested. That's a 7.2% cash-on-cash return. Not bad.
Okay, 7.2%.
Right.
Now let's bring in debt. Same property, same income, but this time the investor only puts down $20,000 cash and borrows the other $80,000.
Right. Now they have a mortgage payment, the debt service. Let's say, just for this example, the total annual principal and interest payment on that $80 loan is $4,860. That's the cost of borrowing.
Okay, so their initial $7,200 cash flow gets reduced by that $4,860 payment. So now they're only pocketing $2,340 a year. The actual cash in their pocket went down. Why is this good again?
Because you have to measure the return against your cash invested. You only put in $20,000, remember? So you take that $2,340 net cash flow and divide it by your $20,000 investment. What do you get?
Let's see, $2,340 divided by $20,000.
Yeah.
That's 0.117. Wow, 11.7%.
Bingo. Your return on equity jumps from 7.2% to 11.7%. You made less absolute cash flow, but your return on the money you deployed is significantly higher. That happens because the money you borrowed costs less in interest than the return the property itself generates. That's positive leverage in action. Powerful stuff.
That is a fundamental concept. Okay, now let's shift to another massive wealth builder in real estate, something unique to it. Depreciation.
Depreciation. The investor's best friend, honestly. Why? Because it's a non-cash deduction. You get a tax break, you reduce your taxable income, but you don't actually spend any cash to get it. It doesn't affect your bank account balance day to day. The IRS basically says, we know buildings wear out over time, so we'll let you deduct a portion of its value each year as a theoretical expense.
And what's the main benefit of taking this deduction?
Well, it's huge. It can shelter your rental income from taxes. Sometimes the depreciation deduction is large enough to make your taxable income from the property zero, even if you're getting positive cash flow. And in really good scenarios, the depreciation deduction might be more than the property's income. That creates a paper loss that can sometimes be used to offset taxable income from other investments you might have. It's a fantastic tax shield.
Okay, what are the standard timeframes? How long do you get to depreciate these assets?
The standard IRS schedules right now say residential rental property apartment buildings, single-family rentals gets depreciated over 27.5 years. Non-residential property, think office buildings, retail strips, warehouses that gets depreciated over a longer period, 39 years.
And you mentioned a little quirk about the first year you own it, something called the half-month convention.
Yeah, it's just a simplifying rule from the IRS. Doesn't matter if you close on the 1st or the 30th of the month. For that first month you own it and put it in service, you get to claim half a month's worth of depreciation. Then you get the full amount for the remaining months of that first calendar year. So practically speaking, in year one, you usually end up claiming 11.5 months of depreciation. Just helps maximize that first year's tax break a little bit.
Okay, standard depreciation is great. But you mentioned an advanced technique to accelerate these write-offs even more, something that separates the pros from the amateurs. Cost segregation.
Yes, this is where things get really interesting from a tax perspective. A lot of accountants, maybe ones who don't specialize in real estate, will just set up two depreciation schedules.
Yeah.
One for the land, which you can't depreciate, and one for the entire building over that 27.5 or 39 years. Doing just that leaves a ton of potential tax savings on the table, especially in the early years.
So what is cost segregation then? How does it work?
Cost segregation is basically an engineering study applied to taxes. You hire specialists, engineers, estimators, tax pros who analyze the property and break it down into many different components. Instead of just building, they identify things like the plumbing system, the electrical wiring, the roof, the HVAC, the flooring, fixtures, all the bits and pieces, and they assign a value to each component.
Why bother breaking it down like that? What's the benefit?
Because many of those individual components have a much shorter useful life in the eyes of the IRS than the building structure itself. So things classified as land improvements, think parking lots, sidewalks, fences, landscaping. Those can often be depreciated over just 15 years. Even better, things classified as personal property within the building carpets, appliances, window blinds, maybe even specialized wiring for equipment, those can often be depreciated over 5 or 7 years. By shifting chunks of the property's total value from that long 27.5 or 39-year schedule into these shorter 5, 7, and 15-year schedules, you massively accelerate your depreciation deductions. You front-load the tax write-offs into the first few years of owning the property.
Wow, okay. So that dramatically reduces your taxable income in those early years, boosting your after-tax return right away. You're basically getting bigger tax refunds or paying less tax sooner just by doing this detailed analysis.
Precisely. It's a powerful strategy to improve earlier cash flow through tax savings. Hashtag 3.4, managing property income tax implications. And we can layer on even more tax strategy when we think about how the income itself is classified, particularly the difference between, say, a short-term rental like an Airbnb versus a traditional long-term lease. This difference can actually unlock some serious retirement savings potential.
Right. Usually income from a long-term rental is considered passive income by the IRS, right? Which often limits your ability to deduct losses against other income, and you generally can't use that income to contribute to retirement accounts like a 401k. How do short-term rentals, STRs, change that picture?
If you actively manage your short-term rental, meaning you're involved in the operations, meet certain IRS tests for participation hours, essentially running it like a business, that income can often be classified as active income, not passive. Now, usually active income means you might have to pay self-employment taxes on it, which sounds like a negative, but active income has a massive advantage. It's generally eligible for retirement plan contributions.
Okay.
Passive rental income typically is not.
That's the key difference. So if you have, say, $25,000 in net income from your actively managed Airbnb that qualifies as active income, what can you do with it?
Because it's active, you could potentially open something like a solo 401k plan. And depending on the contribution rules in your specific situation, you might be able to contribute a huge chunk of that $25,000, maybe even all of it, directly into that tax-advantaged retirement account. So instead of paying into tax on that $25K now, you're effectively redirecting those would-be tax dollars into your own retirement savings, letting it grow tax-deferred or tax-free. It's an incredible way to use your real estate business to turbocharge your retirement nest egg. Hashtag 3.5, planning and execution mindset.
Okay, zooming out from all these specific tactics, the due diligence contingency, the cap rate analysis, leverage, cost segregation, STR tax plays, all of this hinges on actually doing it, on effective planning and, crucially, execution. And here's where it gets really interesting, connecting success back to just making decisions, at closing and beyond.
This might be the most important mindset piece of all, honestly. Think about people who really succeed, not just in real estate, but generally. They tend to make decisions fairly promptly, based on the best info they have, and then, importantly, if the decision seems sound, they stick with it. They change course slowly, if at all. They execute the plan. Now, contrast that with people who tend to struggle or fail. They often change their minds constantly, jumping from strategy to strategy. Or, maybe even worse, they just get stuck. They can't decide.
Yeah, analysis paralysis. And you see how that plays out negatively in real estate all the time.
Absolutely. Indecision and its close cousin, procrastination. They're like twin anchors holding you back, especially when things feel complex or scary. We just talked about that vital due diligence period. You spend 15 out of your 20 days just dithering about whether to hire the environmental expert. You've basically wasted your safety net. You're exposed. Or failing to get that cost segregation study done in the first year or two. You can't go back and recapture those accelerated deductions later. The opportunity's lost.
So it really comes down to connecting your big picture financial freedom, maybe comfortable retirement, whatever your why is, to your actions today. Having a plan and working it.
You absolutely must work from a plan that's aligned with that overall vision. It forces you to focus on what's truly important for reaching the goal, not just what feels urgent in the moment. Real estate has so many moving parts. Complexity is baked in. Success often just boils down to getting good information, making a decisive call based on it, and then having the discipline to execute that plan consistently. Hashtag tag outro.
Wow, okay. This has been a really packed deep dive into those critical final stages of buying property. We've hit the leverage you get from that final walkthrough, the core financial math, using cap rates to find real value, how positive leverage can seriously juice your ROI, and then those powerful tax strategies like depreciation, cost segregation, and even using STR income for retirement savings stuff that keeps working for you long after closing day.
And it really loops back to that idea of ownership, of accountability, which isn't about, waiting for bad consequences. It's about owning the process and the outcome right from the beginning. Ultimately, the only things you truly control are your own thinking and your own actions. But as we've seen today, if you're willing to own those decisively, that's usually enough to navigate even these complex final steps successfully.
Which brings us to our final provocative thought for you to chew on as you think about leveling up your investments. Owning property, especially multi-unit property, inevitably means dealing with tenants, vendors, maybe environmental issues, even potential lawsuits from people looking for a payout. We know insurance doesn't always cover everything, right? There's this sort of litigation lottery mentality out there sometimes. So the question is, what specific legal and financial structures should you consider putting in place immediately after you close to intentionally separate your personal assets, your home, your savings, from the potential liabilities and risks inherent in owning that investment property? How do you build a legal firewall?
Something to think about for sure. Until next time, stay informed and think smart.
And go get those keys. We'll talk soon.